Hello, I went ahead and posted a review document. It reviews notes receivable and accounts receivable, and I'll go ahead and work through that. So if you want to download that document, maybe try it on your own, and then watch this video for the solutions. All right, so let's go ahead and start with notes receivable. On October 1st, we sold $75,000 of merchandise that had a cost of $48,000 to Lois Lane and accepted her note as payment. So we are Danita Company, so let's go ahead and record that. So we are Danita Company. We made that first sale on October 1st. We accepted her note, so that's a note receivable, sales, revenue, to record, acceptance of customer note, acceptance of customer note for payment of merchandise, payment of merch. And then you can put the terms if you want. You can say the terms of the note. It was a 6-month note, 6-month, 8% note. Okay. All right, so we're going to list it at the principal, or $75,000. And because we sold goods in receipt for this note, we have to place that information in here as well. We remember that from a couple chapters ago. That's cost of goods sold and a credit to inventory. To record cost of inventory sold. And our cost was $48,000. So that is your journal entry for October 1st. Yay! December 31st. That's when we prepare all of our adjusting entries. And we know that if we have a note receivable, we're going to need to accrue interest on that note receivable. Okay, so it's going to be interest receivable, since we don't receive interest until the maturity date, which is in 6 months. So right now we're going to put it to a receivable. And then the offset is revenue, interest revenue, to accrue interest on note receivable. And we got to do our calculation. So it's principal times interest times time. Remember that? Principal is $75,000 times interest times time. Remember, this is the 8% is for a year, or 12 months. 12 months. How much time has passed from October 1st through December 31st? So from October 1st to November 1st, that's 1 month. November 1st to December 1st, 2 months, and then the rest of the month of December. So 3 out of 12. So go ahead and do that math. 0.8 plus times 3 plus divided by 12. I got 1,500. We'll try that again just to make sure. Plus good, 1,500. Just want to make sure. All right, so we accrued our interest. Most of the times in the homework, it was just for a year, so it made it really easy. You just had to do 75,000 times 8%, but here it wasn't for a year. It was only 3 months had passed, so we had to prorate it. All right, maturity date. Maturity date, April 1st. At maturity date, Lois Lane honors the note. We said honors is just a fancy word for saying that she paid us cash. Cash is going to be principal plus total interest. Total interest. Let's figure out that piece last, since we have to do a little bit of math for that one. All right, we're also going to collect this interest receivable. So if we're collecting it, we want to reduce that interest receivable of 1,500. We're also collecting the note receivable. Note receivable is the principal of 75. And there's one more account that we need, and that's interest revenue. To record collection of principal and interest at maturity. At the maturity date. All right, let's figure out interest revenue. Actually, I left this one kind of easy. 3 months have passed, so it's just going to be the exact same amount, $1,500. And if you wanted to just make sure, let's add this up. Plus 75, so 78,000 is the total. And again, if you want to make sure, go ahead and take your formula, principal times interest times time. The entire time of the note was 6 months. So this will tell us how much interest in total we should have received. So if you math that out, you should get 3,000. What happened is because of the revenue recognition principle, we had to match 1,500 of it to the prior year and 1,500 in the current year. In total, it's going to be 3,000. And the customer never sees that we accounted for it that way. They just know that they owe us $3,000. So at the maturity date, they're going to pay us the principal, $75,000, plus the total interest, which is $3,000. So we'll get $78,000 from them. All right, part B says, what if instead, at the maturity date of April 1st, Lois Lane dishonored the note, meaning she did not pay it. So if she did not pay it, the journal entry can't have cash because we didn't get cash. So we're going to put it to accounts receivable Lois Lane for the full amount, $78,000. All the other accounts stay the same. Interest receivable, note receivable, interest revenue. So the only difference is that cash wasn't received, so it goes to an account. To record Lane dishonoring note. Something like that. Okay, so that's the journal entry you would do for a dishonoring of note. If the problem takes it a step further and says, oh, on April 15th we realized that Lane was never going to pay. There was no chance of us collecting this. If that's the case, then we write it off. To record write-off of uncollectible account. And do you remember the write-off, the journal entry for a write-off for an uncollectible account? Again, assume she's using the allowance method because we said that's the only one that's GAAP compliant. So assume she's using the allowance method. Think back, what's your journal entry for a write-off using the allowance method? You guys did it in your homework. Go ahead, say it out loud, I can hear it. Just kidding. All right, so when we write off, we use up the allowance, ADA, and then write off decrease Lane's account. Okay, for the 78. Alrighty, so if they had asked us in the second prompt, if it said, we determine her account to be uncollectible, then we would have done the second entry. This problem just asked for the entry to dishonor, which is what's in the box right here. All right, go ahead and flip to page 2 of the document, which is reviewing accounts receivable, and I'll go ahead and show that solution in the next video so this one doesn't get too long.